This is the physical metal panel, gold and silver. And I'm joined this morning by Andy Schectman and Chris Blasi. So rather than me fumble introductions, why don't we start off with who you are, what you do, who you work for. Chris, let's start with you.
Okay, I'm Chris Blasi. I'm the founder and the president of Neptune GBX. Neptune GBX has been around about 22 years. We still function as a full-service precious metals dealer. We also are an exchange operator, and that's because we do have proprietary products that we've developed, but everything is true to physical metals ownership. What we've developed, we look at as in our opinion, and we strip out a lot of the counterparty risk associated with exchange-traded products and funds. So, we're big believers in ownership of the metal, and again, stripping out counterparty risk, but also bringing trading efficiencies and other turnkey programs, and those are centered around storage and related services.
Thank you very much. Andy?
Yeah, so, what Chris said, counterparty risk is, I think, going to be a buzz phrase that permeates through the United States in the coming weeks and months ahead. So owning physical metal in your own possession is something that I think is very, very, very sound advice. I am the owner of Miles Franklin. This February will be 35 years that we've been in business. I'm down here in Delray Beach, where we've had a satellite office for going on 20 years, but our corporate entity is in Minneapolis. We started on a wing and a prayer in 1989, and somehow here we are today, almost 35 years later, and never had a customer complaint ever in 35 years. We're one of only 27 U.S. Mint authorized resellers. We were nominated by Prudential Beige about 20 years ago. We have exclusives all throughout North America with 8 vaults with brinks. Everything is segregated completely and totally. Again, to Chris's point, the removal of counterparty risk is massive, and we believe that as well, whether you take physical possession of the metal yourself or have it segregated, never allocated, but always segregated within a storage facility. And that's pretty much who we are. We're a retail operation for precious metals delivery, physical delivery, and/or storage.
Thank you. Now, the majority of the questions I'm going to ask are going to be focused on sort of retail ownership of sort of physical precious metals, gold and silver, what we would do in this room. But I want to start off before that at a sort of higher level look at precious metals ownership. And one of the key things that's driven the gold price over $2,700 US per ounce is central bank buying, particularly Eastern countries. Why have Eastern countries' central banks been buying so much gold? Who wants to start with that? Well, yeah, Andy.
In 2019, the Bank of International Settlements reclassified gold as the world's only other Tier 1 reserve asset. And this is really the most important thing to understand, in that next to US dollars and treasuries, gold is the only other Tier 1 asset as far as central banks are concerned. It's riskless, it's money, and when you realize that we've seen not only a massive fiscal irresponsibility, where we're creating $100,000 of debt per second, every single second, $1 trillion roughly every 90 days. It took 200 years to do that the first time. You add into it a country that has decided to weaponize the treasury market, and in particular when you look at Russia, Janet Yellen can say to CNN, look, we're okay with Xi Jinping and Putin being buddies in the BRICS. And my initial thought was, well, that's very benevolent of you, Madam Secretary. But she goes on to say that if Xi gives 1 penny to the Russian war machine, we will sanction their banks, their companies, and Beijing itself. Well, never mind the 200+ billion we've given to the Ukraine with no congressional oversight and Stinger missiles and F-16s. It is this type of perceived hypocrisy. It is the mismanagement of the world reserve currency and the irresponsible, wholly irresponsible fiscal policy and the near brain-dead monetary policy on top of the weaponization of the treasury market that is making all of these countries say, are we next? If we don't end up on the right side of the ideological table, will they take our treasuries? Will they take our assets? And when you look at gold over the past 25 years, it has doubled the performance of the 10-year treasury. and it has no counterparty risk. To Chris's point, zero in your own possession. It cannot be sanctioned, it cannot be taken. So these countries are saying, hey, why would we own treasuries that last year represented the first time in 45 years that gold was less volatile than 10-year treasury? It's doubled the performance of it over 25 years, has no counterparty risk. It's a trend that will not stop. And when you look at the BRICS formation, the meeting starting today, and the rollout of their new unit settlement currency, which according to Dilma Rousseff, the head of the BRICS New Development Bank, the former president of Brazil, will be backed by gold by 40%. Any way you look at it, it's a trend in motion, and we are moving, as Zoltan Pozsar says, away from paper and debt promises, in essence, from a country that's broke and insolvent and is viewed as hypocritical, into one that is all about commodities, transparency, perhaps a marriage of blockchain technology, and the removal and absence of counterparty risk.
Thank you, Andrew. Chris, anything to add to that?
Okay, so I concur with everything Andy said. I'll just add a little to it, some great graphics. There is, for people, the thing about gold, which is really beautiful, it's really simple. Right? It's money. There are some wonderful charts that show that hard correlation between the gold price and the growth in debt. So what's the risk to gold, in my opinion? There's short-term pullbacks, but at the end of the day, no administration coming in is going to start shrinking the debt, right? We are in a place where it's going to be continuing to print money and add debt. That's what's supporting the economy. So gold is strong there. So that's why you have central banks of the world who are moving away from dollars as a reserve and moving toward gold. And when Andy talked about the weaponization of the dollar, there's another wonderful chart that shows the inflow and outflow of gold ETFs in the US and the price of gold, tightly correlated up until 2022. And at that point it broke. And as US investors were getting out of the gold market in our ETFs, the gold price is just escalating. And it's exactly because of what we've done. We've overplayed our hand with the sanctions and the weaponization. Yeah, we used to sanction North Korea and Iran, but they weren't players in the world. Now you're sanctioning much more powerful nations, nations that contribute resources that are key to the world, and now the world has decided that they're not going to get kind of pushed around. And this is what you have now with this break. So, you know, these are great charts. I think most people can understand it, and it makes it quite clear.
Thank you, Chris. Now, I think it's clear that several Eastern countries consider gold a strategic asset. There's a lot of talk about strategic minerals. China, Russia, and others see it as a strategic asset. Why doesn't the US see gold as strategic? Chris, do you want to take that?
From a national government level, well, what they say in public and maybe what they think behind the scenes are going to be two different things. I think, I think the U.S. has our whole economy, right? We've become a very financialized economy. We don't appreciate, I think, the value in real assets, which is why we're seeing that I think we're in a predicament. We've seen this in our approach to manufacturing and the ability, we're just going for short-term, gains and strategically crippling your nation. We see that we're vulnerable now with supply chain issues because of this economy that we've created. And then, I'm just in the gold and silver world, and I'll just say that this is another thing that the U.S. has not appreciated on a national level and as an individual investor level. I know we harp on, and we've said it multiple times, but the counterparty risk, everyone is so cavalier about counterparty risk in all sorts of investment vehicles. You look at hedge funds and stuff, they think owning a futures is owning gold. It's not. It's a betting instrument. And in the very near term, investors are going to find out that being in possession is going to be paramount.
Thank you. Andy, anything to add to that?
I think that first and foremost, everything is valued in dollars. And, Fort Knox hasn't been audited in about 70 years. Even when Ron Paul says we need to audit Fort Knox, he's turned down. Let's simply say that it's in the vested interest of this country to hide gold's real value, whether it be through massive shorting on COMEX or the LBMA by the Western banks. In silver right now, you have 8 Western banks that hold the largest concentrated short position in any commodity ever traded on COMEX. And the LBMA, they're trading roughly double annual mine supply per day in gold and 3.5 times annual mine supply per day in silver, upwards ends of 2.9 billion ounces. They say they trade 292 million, but they admit it's 10 times under reported, as they only report the final settlement numbers. In gold, it's somewhere in the neighborhood of 200 million ounces per day. 90% is naked paper shorting by the banks who want to maintain the illusion of dollar and bond market supremacy, which is beginning to falter. And you have a whole generation of financial advisors who have been led to believe that gold is a barbarous relic with no value, yet it's beat the performance over the last 25 years of the S&P 500 just narrowly with dividends reinvested, averaging about 9.9% to about 9.6 in the S&P. As I mentioned, it's doubled the performance of the 10-year Treasury. But the real issue is, and you can see this with both gold and silver, which broke out to all-time highs against every other currency on the planet before it did the dollar. And that is because of the inordinate and unjustified strength of a currency that is being destroyed. A currency that is at 123% debt to GDP. A currency that is 36 trillion in debt with 150 or 60 trillion in unfunded liabilities. Medicare, Medicaid, Social Security, government, military pensions. We're broke, we're insolvent. There has never been a country ever in history that's crossed 130% debt to GDP and come back without either hyperinflating or outright defaulting. And it is in our best interest to maintain this illusion by stepping on the price of gold. There's a term in economics called Gibson's paradox, which loosely explains the inverse relationship between real interest rates and gold. And for all of these years, the West has suppressed interest rates to financialize everything, to make our homes into an ATM so we can refinance, to make our stock portfolio and our 401k go up higher and make everyone feel wealthy as we've gutted our manufacturing. And they got caught. We are caught now in a rising interest rate environment and an inflationary environment. And I think what you have right now is an existential threat to some of the biggest commercial banks on the planet who are naked short, because what is different right now is that the US is trying to maintain this illusion that gold and silver aren't important. Now we have Judy Shelton on the scene saying, you know, the only way people would be smart enough to buy a 30-year treasury is to make it partially redeemable in gold. There's a little bit of sanity out there, but what it really means is that you have a good portion of the world, in particular India, Russia, and China, who understand the way to beat the West is not by throwing missiles at us, but by exploiting the back end of these contracts, which allow for delivery. And they are using, like jiu-jitsu, the leverage of our stupidity by continuing to naked short gold and silver to maintain this illusion. And we are clinging to the hegemony of the dollar, which is gone. So it will come, there will come a realization, people in this country will be like, oh my God. Let me just, one other thing real quick. You know, there was a bank bail-in basically on Friday. No one's talking about it. This bank in Oklahoma, it was bailed in. Now, you can say what you want. The FDIC took it over. There's $7 million in uninsured deposits, and they said half of those uninsured deposits will be available yesterday, and the other half maybe will be available when they sell off the assets. The FDIC has 4 years to do that. Well, what if there's a couple big banks that do that, and the people in this country realize that the banking system is over-leveraged, undercapitalized, and in big trouble? There will come a collective awakening in this country that the road to retirement isn't always paved with mutual funds and stock certificates, and it is being hidden to us by the people up above who want us to believe that all you need to do to retire is to buy stocks, bonds, and keep in dollars. And I would say we are at a point in time where if you're not a contrarian, you're damn well bound to be a victim. And that will change, but the US has done a pretty damn good job of hiding it. The importance of real commodities, the rest of the world is using that against us.
Okay, thank you. Now, as you mentioned, the BRICS are meeting today in Russia. I think 36 world leaders there, and one of the key talking points is obviously the creation of a BRICS currency, as you say, gold-backed. Let's bring the conversation to retail investors. Why buy physical gold rather than a gold ETF? You want to start with that, Chris?
Sure. It goes back to, again, counterparty risk. I mean, this is one of the few assets that you can actually hold and take in your possession, right? So if you look at other commodities that will do well in the years to come, they're not productized in a way that you can completely control it. I mean, oil you can, you're not going to put a silo in your yard. So I've always taken the position, why would an investor, except for this perceived convenience, but it's like a lot of conveniences, you give up rights, right, when you perceive something as being convenient. But why would you surrender that so-called convenience and not have full control of the underlying asset? So, except for, like, in my opinion, if you're just going to trade your gold short term on a day, a couple days, all right, that's what GLD's for, right? Tracking the price of gold. That is not gold ownership. I don't even think ETFs are used incorrectly in the world of gold. It was something Wall Street created, and now it's the one way. But again, it comes back to the simplicity. If you can take control, you have no control. Your stocks are all held by the DTCC. You don't own anything. Everything's in street name. Why would you not? You know, people talk about diversifying your portfolio. That's like it's like location diversification. Why would you have it all custodianed on Wall Street? Why would you not at least take that part, separate it from that? So that's portfolio diversification, and that's asset diversification. But unfortunately, you know, as Andy said, the indoctrination, the propaganda, and of course, since the typical wealth advisor doesn't have a way to be compensated from that, you know, if they're clearing through NFS and Schwab and all that, that's not something they're ever going to promote. So unfortunately, retail investors have got to do their own homework and come to these conclusions on their own and act outside of their traditional brokerage accounts.
Yeah, very well said, and I agree with all of that. And let's just look at it from a few different levels. First of all, you read pages 6 through 12 in the prospectus on GLD and SLD. You really read it. If you don't dump it, I'd eat my hat. You know, they talk about things like the custodian reserves the right to use sub-custodians, but is not responsible for the errors and or omissions of said sub-custodians. If the gold bars do not meet London Good Delivery Standards, well, you know, they're not responsible for it. In other words, if they're lead bars painted gold, it's not their problem. And who is the custodian of these trusts? Like SLV as an example, the world's largest silver trust. Oh yeah, that's the company that paid a $920 million fine to the Justice Department for manipulating the market, JP Morgan, and probably the biggest crook in terms of suppression of metals prices in the last 20 years, and yet they're allowed to be the custodian of the world's largest silver trust along with BlackRock, and JP Morgan has their fingers in GLD as well. When you sell GLD and SLV, which your broker will tell you is a good thing to buy, you pay the 28% collectible capital gains rate instead of the regular capital gains rate. There is a management fee that is deducted from the gold held in the trust, so that's why it never equals exactly what it's supposed to when you divide it out, a tenth of an ounce of gold or whatever it is into the price of gold. It's stupid. It creates an inequity. They allow you to naked short this damn thing. I mean, you can naked short an ETF. How stupid is that? And it is a tool of suppression. But not only that, I think it goes far beyond that. You know, people ask me all the time, should I buy numismatics because the government's going to confiscate gold? And I say, look, I love numismatics. I've loved them my whole career, pre-33 US. This is the first time since Obama took office that I would even consider selling them to people, as the premiums have come down to a level that is worth consideration. I've always focused, as Richard Russell said, in the end, it's about number of ounces that you own. But I think about confiscation, and I think about a country clinging to its world reserve status, a country that tries to tell the world we're the center of free trade and liberty. I mean, you look at what's happened in this country, and that's debatable in and of itself, but you want to kill and turn on the kill switch, confiscate physical gold, do eminent domain. A better way to do it would be on a Friday night, everyone's accounts in GLD and SLV are gone. It's in your money market. Those accounts have been closed. And they look the world in the face and they say, what? We didn't do anything. We didn't activate eminent domain. We didn't infringe any civil liberties. We didn't break any laws. All we did is close these two accounts with which the prospectus gives us the right to do. You all can never take possession of that metal unless you are able to do it in the form of a basket, which is what basically the commercial banks who funded it, massive amounts, are able to do. And sometimes even close that option down for the big boys. But the point of it is that they could be sitting on the largest stockpile of silver in the world in SLV and the third or fourth largest stockpile of gold in the world in GLD, held by the criminal banks like HSBC and JP Morgan and BlackRock, who are involved in suppressing the metal. And it isn't a conspiracy. JP Morgan paid that fine and admitted to it. So why would anyone do that? They could have their cake and eat it too. It's still legal to own physical metal in this country. It goes back to what Chris was saying. The most often overlooked point of owning physical precious metals has nothing to do with economics. It has nothing to do with anything, but it is removal completely and totally of counterparty risk. And to his point on the DTCC, if you all haven't watched The Great Taking by David Rogers Webb, you really need to. And he can go to his website, greattaking.com, or you can go to YouTube, which I prefer, and watch him narrate his book. It's an hour, 20 minutes or so. And if you haven't watched it, and you haven't understood completely what counterparty risk is and what is going on with the DTCC, and you are subordinate in terms of your place in line of ownership to an entity like JP Morgan, it's already been stood up in law, meaning in case law. To me, buying GLD and SLV is the biggest cop-out in the world. It is not physical metal. It's a poor representation of price at that. And when you pay a management fee, what the hell would you want to buy this for, if not buy the real thing with no counterparty risk, outside the matrix, outside the system? To me, it's not even a debatable choice.
Okay, people talk about investing in gold, but let me ask, when holding gold or looking to hold gold, should people consider that investment? Should they consider it insurance? Should they consider that something else? Chris?
It's wealth preservation, right? I mean, that's the way I look at it. You know, if we say gold is money, right, it's money that's going to hold its purchasing power. You know, silver's the same thing, but gold is really the primary one for wealth preservation. And that's the correct way of looking at gold, right? I mean, I know the price is going up now, and you're going to get some retail people that come in and they're going to kind of behave like speculators. Physical gold is for an intermediate to long-term hold. It's it should be the foundation of your wealth, of your portfolio. So, you know, that's it.
And what sort of percentage of portfolio should it be?
Okay, so everyone loves that question, right? So I'm going to say, I mean, I have extremely high percentages. I know people like to use the textbook, 8 to 10%. I'm not an investment advisor, so I'm not, let's make that clear. I mean, I think you have to have a material enough position so that when what's probably going to take place, especially over the next several years of repricing of a lot of assets and a lot of financial assets, that those positions in gold and silver are significant enough to keep you on level ground and not suffer losses. I mean, I've heard retail people say, well, you know, I've got $10,000 in gold, right, on a $1 million portfolio. It's useless, right? I mean, it's nice. It's not going to bail you out. So, personally, again, not an advisor. You have to make your own decision. But I can tell you that the clients that I see who've had 10% positions for a while are now moving them up significantly. A lot of them are moving to 20 and 20% plus. And these are very knowledgeable people managing large personal portfolios.
So it sounds from your answer there, Chris, that there's perhaps no set figure. It fluctuates depending on the external conditions you're looking to protect your wealth against.
Not so much. I mean, I held it for 25 years. Never changed that position. It actually just grows. I mean, the reason I'm not giving a hard number is because, again, I'm not an advisor, and it's something that a person has to use their own logic. You need to, I mean, if you take in what Andy and I have both been saying today, you would probably come to a conclusion that an 8 to 10% position may be a little light. but that's a decision an individual has to make. And I would assume, especially with an audience like this, that naturally they may be more predisposed to feel comfortable with a larger position.
Okay. Andy, anything to add to that?
So not only is gold wealth preservation, it is wealth since the beginning of time. You know, pharaohs, emperors, kings, queens mentioned in the Bible hundreds of times that, you know, pharaohs didn't call their gold broker and say, you know, I need to buy some gold. They owned it as a form of immutable wealth throughout all of time. When I started my company, I was 19 years old with my father. He said, I won't let you make the same mistakes that I made. And we started on a wing and a prayer. You know, my father's middle name is Miles, and his best friend who lent us $60,000 in 1989 to start a company in a one-room office, his middle name was Franklin. He says, you're gonna buy something every 2 weeks or I'll fire you. All right, that's the only rule I can deal with that. I've owned the company outright for a long time. I've honored my word to my father. He will not fire me anymore, although I talk to him every day. He's still in many respects my partner. And I have bought gold and silver every 2 weeks without fail for 35 years. I have never, ever, ever missed a 2-week period. To me, what gold and silver are is wealth, and that was the greatest gift he ever gave me. The gift of compounding, the gift of understanding to pay yourself first, and I would much rather hold my money in a form that is not being debased. Let me explain in an essence what that means. I did an interview a few weeks ago with a guy from the UK, and he said, you know, money creation in the United States has been running 7% for the last decade. Now, I would argue that's a little light, but when we talk about inflation, money creation is inflating the money supply. It is the classic definition of inflation, is a monetary event. Rising prices, CPI, CPI is the consequence of inflation. But let's just use a 10% or 10% money creation, as he says, for the past 10 years, right? So, or 7%, excuse me. So if we take 7 into 72, excuse me, yeah, that's right, 7 into 72. So that's the amount of, you take your interest rate and divide it into 72, the law of 70 seconds. It tells you how long before your principal doubles. So if money creation has been running at 7% for the last 10 years, 7 into 72, it's a double. In this case, that means your dollar was worth twice what it is today 10 years ago. Well, what was gold 10 years ago? It was $1,200. So did gold go up to $2,700, or did the dollar fall by half? And what you need to understand, you can go back through all of time. You can look at a $20 gold piece in 1930, which would have bought you a full outfit, suit, tie, shoes, you name it, the whole 9 yards. And Grandpa left you 2 boxes in 1930 for you. One box was $10,000 in $20 gold certificates. Now, yes, the gold certificates are worth much more than a $20 bill, but the point will be the same. 10 grand in $20 bills, yeah, it's nice, sure, but, or let's just say that $20 bill, let's do 10 grand. 10 grand in $20 bills is nice, but the exact same commensurate amount in the price of gold, those 500 ounces, that's worth well over $1 million. And if you use that same $20 gold piece that bought you the whole suit, it doesn't even buy you shoelaces anymore hardly, but the 1 ounce of gold buys you the same outfit. It's about retaining purchasing power. So to his point, it is wealth preservation, and to my point, it is wealth. And I think you see that by the most well-informed traders in the world. The central banks buying it at a level the world has never seen. They don't look at it as an investment. They look at it as a much better way to hold their reserves than US dollars and US treasuries, which are being inflated and weaponized. And this is just a trend that is going to accelerate exponentially, in my opinion.
Okay, you can buy physical gold in many denominations: 1 ounce coins, 1 ounce bars, 10 ounce bars, kilogram bars, 10 kilogram bars. For a retail audience such as this, what's the best unit to hold gold in? Chris?
Okay, it depends on a person's requirements, right? So gold is, as long as it's all gold, right? If a person's taking delivery into their possession in their homes, that's definitely makes sense in the world of coins, right? It's very logical, maybe even small bars, 1 ounce bars. I would shy away from larger 10s and definitely not kilo bars going into the hands of the general public. Kilo bars, you know, some people will get enamored by them because the premium per ounce is is lower than a 1 ounce coin or 1 ounce bar, but it's not a retail item. Those are really meant to be held in storage. And also they're not very divisible, right? So as gold goes much higher, 5,000 or more, and you want to maybe, you need to raise a little capital, you'd be forced to sell a whole kilobar, right? Which is right now about $86,000. So, the divisibility of the 1 ounce increments are pretty ideal for individual investors, again, especially if they're taking delivery. But as long as the bars are LBMA bars, they're from that select refineries, to me, they're all good. I don't look at them as different. It just comes down to what is the requirements, how is the individual going to use this? Are they going to need it in the later years to start selling pieces of it off in the retirement? So therefore you want something that's more divisible than large bars. But if you work with a good dealer, right, and they should ask you what your requirements are and really decide together what's right.
Well, let's dig a little bit deeper into some of the points you're making there, Chris, in terms of the costs of holding gold, whether it's in a vault or in your house, because obviously vault service, as you suggested, there's cost to that, there's insurance if you hold it at home, ease of cost of selling. Again, can you give some sort of thoughts or guidance on those aspects?
Sure, I'll just say one thing. Of course, the risk at home, right? It could get lost or stolen, and it does happen. And I'm just going to go back to one thing on the ETFs, especially with the larger holders. Andy talked about, they have management fees, right? And depending whether it's a gold ETF or a silver one or a trust, these management fees generally run from 41 basis points up to about 58 basis points. I mean, our large customers or even our mid-sized customers, they're able to store, they own the metal, it's in a depository, and they have a cost to carry that's lower than that, right? They're not paying 41, they're more in the neighborhood of 20, 25. So when you're holding something like gold and silver on an intermediate to long-term basis, right, that should mean something, right? So yeah, there'll be a little bit of premium because you're actually going to own the asset, but that's the cost of actually owning an asset, not surrendering your rights to an ETF. But then over time, you're going to have a lower cost to carry. So, which is again better than the ETFs. And when people store in a depository, they're going to pay for it, right? They're going to get invoiced for it, where they're not going to liquidate their position, which kind of defeats the purpose, right? You buy an ETF and they slowly are selling it off anyway, because that's the only way they can pay for their management fees.
Okay, gold is gold, or is it? Does it make a difference which mint you buy from? Let's frame that within the context of, Costco started selling 1 ounce gold bars last year. I think they're MKS PAMP. Does it make a difference which mint you buy from?
This is a personal thing. Say, since you brought up 1 ounce bars with a Costco, if you look at the major, whether it's PAMP or RCN, Valcambi, they're all good. These are all LBMA approved refineries. If a person is predisposed for whatever reason to one over the other, that's just a personal choice. But as far as value of the asset, there's, in my opinion, there's no difference. And they're selling good delivered bars. It's a good product. I think there's limitations to how much they can sell to the individual. They're really not able to fulfill orders of any size. Yeah, I think it's 5, and even maybe a limit to how many times a member can buy. But it is good bar. Those are good bars.
Okay, we're rapidly running out of time. So in closing, let me ask the panelists, what's the one key thing retail investors should have front and center of mind when considering buying gold? Miles, Andy.
Well, there's no right or wrong way to do it. This industry lends itself. People initially want to be penny wise and pound foolish and get large bars or larger pieces at a smaller premium. I think that's a mistake. I think you can never be too flexible, whether you're playing poker with your buddies or driving on Highway 95 with bumper to bumper. You can never have too many exits, too many outs, too many options. Not to mention, there are 11 states in this country that have passed legal tender laws. There are 21 more that have it on the docket. And they all say that coins, some say specifically US mint, like Oklahoma and I think Texas, but most say coins issued by a sovereign mint would be used or able to be used for all debts, public and private, including paying your property taxes. This is a trend that I can't believe that we are seeing. I think there is a lot to be said for owning coins. I think there's no reason in gold to ever go bigger than 1 ounce. I think it's penny wise and pound foolish, completely and totally. In silver, I guess you could go up to 100-ounce bars, but if I had my druthers, period, it would be probably American Eagles, gold and silver, period. I mean, they're the most recognized, the most visible, the most sought after, the most privacy, no dealer reporting requirements on sellback. You can't say that about bars or rounds in certain quantities. To me, it's about not being penny wise and pound foolish. It's not by buying from companies or sources that are not reputable, and it's about realizing that on the back end is something you need to think about. Liquidity on the back end. You know, kilo gold bars mentions the cost of carry. Who wants a kilo gold bar when you can have 32 1-ounce gold 1-ounce bars or 32 1-ounce gold coins for a very small premium to the kilo bar? The savings is not commensurate with the complete and total lack of flexibility. And in a world where gold continues to march higher, where Senator Loomis from Wyoming can advocate for revaluing the gold that the Federal Reserve supposedly is holding on behalf of the Treasury to fund a Bitcoin account, where the head of the Dutch National Bank says we need to revalue gold. And ironically, by the way, gold is held in every central bank balance sheet in something called the gold revaluation account. They are noticing that gold must be tied to a new system, whether it be on the state level or on the central bank level. They notice this, and if they don't, no one will ever drink the punch that has been peed in ever again. We have destroyed the credibility of the system. It must be tied to something. This is the marriage of blockchain technology and gold. This is why guys like Jim Sinclair, my friend, God rest his soul, said gold will go to levels that no one can imagine, and it will never come back down. It will be pegged to a new system, and it will. This is why Kristalina Georgieva, the head of the IMF, says a CBDC not pegged to something is fiat, and 6 months earlier issued a report saying from the IMF, gold, a international reserve currency, comma, a barbarous relic no more. This is why the central banks are buying it. This is why the unit settlement token will be pegged to it. Gold is just beginning to be remonetized and valued far more than the currency that is used to purchase it worldwide. So when it comes to this type of situation, the thing you want the least are big bars that have zero liquidity. You want the 1-ounce coins from the United States Mint or the Canadian Mint that have immediate non-subjective liquidity, sight unseen, just like that. And to me, everything else is inferior. But there is no right or wrong way. I mean, there is no established protocol. But I would simply say, if I had all of the coins laid out in front of me, and they said, take one of each, it would be platinum eagle, a gold eagle, and a silver eagle, and you will never, ever, ever have problems with liquidity anywhere in North America, sight unseen. And you may just be in one of the states. This state right here has it in front of their legislature. I work with some very influential people here in Florida. I live in Florida, that are moving this into the legislature, just like a lot of the other states, Texas, Wyoming, Alaska, Idaho, Nevada, Oklahoma, the list goes on. 21 states are considering it, 11 have passed it. Don't make the mistake of being penny wise and pound foolish, ever. And because in the end, when you own gold, it's there for an opportunity or emergency. And the last thing you want to try and do is convince someone it's the greatest thing since sliced bread. Instead, you give them an American Eagle and bang, that's cool, I'll take it, how much? And although I'm oversimplifying it, I mean it sincerely, and that comes from 35 years of doing this and seeing what everyone wants and what is the most liquid, not only to the public, but also to the secondary market, to the dealers and the refiners and the wholesalers.
Chris, for you, what should investors have front and center of mind when thinking of buying physical gold?
Well, Andy touched on a lot of points. I did a little bit lighter before. One point he makes is very important. When people, as he said, penny wise and pound foolish, when we're talking difference in premiums, we're talking not big numbers, right? I mean, the savings of, you're talking maybe a 1%, sometimes 2% savings. You know, I remember when gold was $1,000 an ounce, but someone going to save $20 an ounce and maybe buy something that really is inappropriate. Again, I separate the take delivery market or the general regular investor, especially if you're taking delivery. You may want to sell this coin privately to another individual in years to come, and a lot of these people are not going to have the acumen to really know the nuances of our market. So to a dealer, PAMP, as you mentioned, and RCM, yeah, those are household names, but they're not to the general public. A lot of people will just be getting their head around gold. So if you show a sovereign coin, it's going to be quite self-explanatory. It's going to be, that's like liquidity factor, easy to market, right? So if you're going to do a private sale, ideal. I mean, at the end of the day, the people that buy the large bars are a handful of very large investors, which increments of $90,000 doesn't mean anything to them. That's what they like to do, and that's appropriate for them. But for the vast majority, it's going to be the small bars and the coins. And taking delivery, I really think it's just hands down, it should be coins, because that makes the most sense. That's going to hit, when I said about an individual's requirements, right? That's going to hit all the requirements, right? Visibility, marketability, liquidity.
Excellent. Well, we're out of time, so please join me in thanking Andy Schectman and Chris Blasi.